Major U.S. equities are trading on a mixed note. Also, we're seeing crude oil futures trade flat. Joining me this afternoon is Stephen Guilfoyle of Deep Value Executions. Stephen, thank you so much for joining me today.
Remy, thank you for having me.
Well, we kicked off March with a very strong start. We saw the equity averages all rally and post their best gain for the beginning of March. So what do you make of all of this volatility? Are we back in 2008 or not at all?
Well, we did see a large inflow into mutual funds yesterday. That was really the catalyst, plus some decent macro. So we had not completely unexpected, but maybe to the level that cash levels were depleted yesterday was really kind of a surprise. But everything else was pretty much expected. And I think as you saw the exit polls coming out of Super Tuesday, I think that also cemented the move yesterday because I think the market's much more comfortable with both Hillary Clinton and Donald Trump than with whoever might be their challenger on either party.
And Sarge, we can't forget about oil prices. Right now, we are flat on the session, but earlier we did get a boost following those EIA numbers. So what do you make of what we're seeing in oil prices?
Well, how about that, huh? We get a 10 million barrel increase in supply, and it doesn't hurt the price of oil. All right? Oil is no longer trading on fundamentals, or maybe it is. Maybe it's forward-looking fundamentals. We've seen drastic cuts in the rig count. We've seen a lot of countries talking about production cuts. We know they're going to have to jump off the cliff sooner or later. We've seen talk from Mexico, talk from all over Saudi Arabia and that part of the world. So, and let's not forget U.S. shale, which a lot of it's come offline since oil's been down here. And a lot of it won't come back online until oil's in the 40s. So I think forward-looking, even though it looks horrible, even though supply is so high, I think people are starting to think that their range is going to be support around 33 and maybe resistance up around 40.
And of course, we can't forget about the ADP numbers that we got earlier today. They did come in better than expected, and all eyes are on that jobs report coming out on Friday. But if we take a step back and look at U.S. data, the reaction to the ISM manufacturing, construction spending, and auto sales were really good. But what do you make of the data, and does that change your Fed rate expectations?
Well, the data has been getting a little stronger. And let's not forget construction spending yesterday. That was the big one, all right? That was 1.5% month-over-month increase from December to January, and December was ratcheted a bit higher. Now, construction spending is huge, and it's usually awful in January. So that stands out to me as the biggest one amongst a flurry of slightly better numbers here. And the Federal Reserve works for the banks, all right? If they can get away, if they can justify an interest rate hike, they're going to do it. And we have seen some increases in core CPI, core PCI, which more or less justify this. I think that we probably are headed for another rate hike, probably sometime in the first half. I don't think it'll happen in March, but sometime in the first half. And I think that's what they're working towards. And the statistics right now are helping them.
And last but not least, Sarge, now that we've covered the U.S., we can't forget about the rest of the world. In terms of China, Moody's downgraded their credit rating, but for the most part, people did not pay close attention to that. We did get the inflation data out from the Eurozone. We have the ECB rate decision coming up, and talk of the Brexit has quieted for now. So what are you paying attention to overall?
I guess, the Chinese thing from Moody's didn't really matter to the market. A lot of Shanghai Composite was up 4.5% today or something like that. And Moody's has been wrong about a lot of stuff over the years, so I don't think we're that worried about that. I think the ECB is the big one right now, okay? They can't do anything to create inflation over there. They're already in negative rates. They're already buying about as many things as they can create for quantitative easing, so they're going to have to get creative in that regard. We're all pretty sure that Mario Draghi is going to pour a little more kerosene on the fire. He's going to have to ease, but he's going to have to be creative to do so. So it is going to be very interesting, and traders over there in Europe and guys who trade Europe from here are trying to price it in, but they're really not sure how to go about it just yet. We need a little more development, but that's where to look.
Well, we'll have to keep an eye on all those development going forward. So thank you so much for weighing in on all these issues in the middle of the week.
Oh, Remy, thanks for having me.